February 19, 2026, 7 o'clock Singapore time. Americas. U.S. equities were choppy over the last session. The Dow finished slightly lower while the S&P 500 and Nasdaq eked out small gains, with trading dominated by a tug-of-war between strong earnings momentum and concerns about fast-moving AI-driven disruption in parts of tech. Market leadership rotated toward defensive and rate-sensitive groups, with utilities and real estate outperforming even as several cyclicals lagged. A separate market update highlighted that the S&P 500 pushed higher with Nvidia among the most influential drivers, reinforcing how concentrated index performance remains around mega-cap AI names. In Washington, the U.S. Treasury issued interim guidance on the Corporate Alternative Minimum Tax, CAMT, explicitly framing it as a compliance burden reduction effort while signaling a broader reproposal of the framework to make rules more predictable for large companies. The policy move matters for multinationals' effective tax rate planning and could influence capital spending timing if firms expect a reset in how CAMT is calculated. On the capital markets front, Wells Fargo's equity strategy commentary pointed to a constructive IPO backdrop, suggesting underwriting pipelines may thaw if volatility stays contained. Net-net, U.S. markets are still trading macro-light and mega-cap heavy, with policy clarity and the AI earnings cycle doing more work than fresh top-tier economic releases. Europe. European equities extended their rally, with the Stoxx Europe 600 pushing to fresh record highs and banks, defense, and healthcare among the notable leaders. The UK was a key macro input. Inflation cooled toward the low 3% range while unemployment ticked higher, a combination that markets interpreted as strengthening the case for Bank of England rate cuts sooner rather than later. In Italy, deal and banking headlines helped fuel sharp single-name moves, including a surge in Mediobanca, underscoring that M&A and regulatory outcomes are still powerful catalysts in a relatively calm index tape. On the regulatory front, the European Commission opened a formal investigation into fast fashion platform Shein, an action that highlights the EU's willingness to pressure large cross-border e-commerce players on product and platform compliance. Separately, EU competition authorities cleared ING's acquisition of Goldman Sachs TFI, illustrating that consolidation in financial services can still pass scrutiny when competition remedies and market structure support it. Markets also watched central bank and leadership chatter after reporting suggested ECB President Christine Lagarde could leave before the end of her term, an unconfirmed storyline, but one that can move rates and the euro if it gains traction. Bottom line, Europe is rallying on easier rate expectations and sector leadership, while policy and enforcement actions, from competition to platform rules, remain an important overlay for corporates. Middle East. Gulf equities pulled back amid renewed geopolitical sensitivity around U.S. Iran nuclear talks, as shifting official commentary injected risk premium back into the region's market narrative. Oil was steady to firmer in that context, with Brent trading around the upper $60 and energy pricing acting as the key transmission channel from geopolitics into regional assets. Saudi Arabia continued positioning itself as a global services hub, with Moody's announcing a new regional headquarters in Riyadh, an incremental but symbolically important step as the kingdom courts international financial and professional services firms. Dealmaking remains active. Analysis of the region's M&A landscape points to continued momentum into 2026, with capital deployed selectively across energy supply chains, digital infrastructure, industrial localization, and healthcare. In capital markets, expectations are building for a surge in sustainable bond issuance led by the UAE and Saudi Arabia, with forecasts in the $20 to $25 billion range for 2026 as sovereign frameworks and corporate net zero programs broaden the issuer base. At the company level, Oman Flour Mills agreed to acquire a 33.34% stake in Arabian food production, reflecting steady consolidation in food and consumer supply chains. Overall, the Middle East's business picture is a mix of strong structural investment programs and near-term volatility tied to geopolitics and oil. Asia-Pacific. Asia-Pacific headlines were led by a combination of trade, fintech, and multilateral financing. In Singapore, DBS and Visa launched a first-in-region pilot of agentic commerce, trialing tokenized card payments designed to let AI agents execute purchases across online and real-world scenarios, an early signal of how payments rails are being adapted for AI-mediated transactions. On the development finance side, the Asian Development Bank and the World Bank signed a $3 billion agreement aimed at expanding lending capacity across Asia and the Pacific, supporting infrastructure and resilience funding at a time when many governments face tighter fiscal space. Trade and investment diplomacy also featured. Canada's Minister Sadu used stops in Singapore and Vietnam to push Canada, ASEAN free trade negotiations and to spotlight advanced manufacturing and clean tech investment links, alongside a financing package involving the ADB and Vietnam's BIDV. In markets, commentary highlighted that Asia's equity performance has outpaced the US so far this year, with investors rotating toward emerging markets and parts of North Asia as narratives about US exceptionalism are retested. Region-wide sustainability remains a major constraint. A new assessment suggested Asia-Pacific is on track to miss most sustainable development targets by 2030, with notable gaps in climate and biodiversity goals, an issue that will increasingly shape capital allocation and regulation. Finally, longer horizon macro debate continues around China's growth model, with international institutions emphasizing a pivot toward consumption-led growth as policy priorities evolve into the 2026 to 2030 planning window. Taken together, Asia-Pacific is seeing fast innovation at the payments layer, steady expansion in public lending capacity, and an investor rebalancing that is sensitive to both geopolitics and the region's long-term transition needs.